The collapse of two prominent American banks, Silicon Valley Bank in California and Signature Bank in New York, has been reported as the second largest banking failure in American history, after the 2008 collapse of Washington Mutual Bank. The 2008 financial crisis followed the Washington Mutual Bank's collapse and caused a global recession, which has led to concerns that this latest banking failure could spark another recession. The potential impact of America's financial system crashing is a cause for concern, as it could have repercussions worldwide. What's up everyone, and welcome to our YouTube and Facebook channel. If you are watching our channel for the first time, please consider subscribing, and if you like our videos, please give us a thumbs up. And now, let me tell you about the story of Silicon Valley Bank collapse. Silicon Valley Bank is a California-based financial institution that specializes in providing commercial banking services to technology and life science companies, as well as venture capital and private equity firms. The bank was founded in 1983 and is headquartered in Santa Clara, California. Initially, the bank invested a large chunk of its money into real estate. In the early 90s, half of this bank's portfolio was made up of real estate property business. And in 1992, California's real estate market crashed terribly. Due to this, the bank incurred a loss of $2.2 million. After this, the bank realized that they need to diversify their portfolio. So after 95, the contribution of the real estate business has remained around 10%. Moving on from 95 to 2000, this bank was heavily investing in startups, especially technology-based startups. In addition to lending, SVB also provides advisory services to startups, helping them navigate the challenges of early-stage growth and access to venture capital. By 2015, the bank had expanded so much, it was reported that 65% of all startups in America were served by this bank. By the end of 2022, SVB was the 16th biggest lender in America, with the value of its total asset at $209 billion. The problem began with the COVID-19 pandemic. With global lockdowns, venture capitalists from all around the world began investing in software companies. In 2021, the startup raised a lot of money. In America, $330 billion was raised in total, and SVB was #1 preference of technology-based startups. This is why in March 2021, the value of total deposits with the bank was around $124 billion. It was $62 billion more than the year before. Since the bank had so much money in the form of customer deposits, they decided to use it to make even more money. So SVB used $1 billion to invest in government bonds. Banks have their business models. They can invest the deposit at various places to make more money. And investing in government bonds is considered relatively very safe. SVB bought a large number of bonds at a time when the prevailing interest rates in the market was quite low. According to America's Federal Reserve, the interest rates were around 0 to 0.25%. It was expected that the interest rates would remain low, but this didn't happen. The interest rates increased. By raising the interest rates, the value of the bonds held by the SVB crashed. They suffered a huge loss. But this wasn't the only loss. The second negative impact was even greater. By increasing the interest rates, their interest rates on borrowing loan increases as well. For startups and companies, taking loans became more expensive. So the other option was to use the money they have deposited into the banks. The tech startups wanted to withdraw their deposit to meet financial needs. Venture capitalists were not funding them anymore. Since they had their deposit with SVB, they wanted to make withdrawal at the same time. It became problematic for the bank, as the funds they had invested were incurring losses. Due to the demand of the customers, SVB started selling the bonds. Recently, they sold about $21 billion worth of bonds at a loss of $1.8 billion. As soon as the news became public, the value of the shares of SVB started falling. On 9th March 2023, the shares of this bank were down by 60%. Although there was no scam and the bank did not commit any fraud, this is a case of bad decision making. People in charge of the management of the bank made wrong decisions at the wrong time, and to some extent, this was a simply bad luck. Now, the question is, why did the government do this? And the answer is to control inflation. When the economy of a country is facing a slowdown, the central bank often reduces the interest rates. And if inflation is on the rise in an economy, interest rates are increased to control it. Increasing interest rate would make loans more expensive, and less people would want to take loans. People would not have enough money to spend, and the spending would decrease. With lower spending, inflation could be controlled. Now, the next question. What would happen to the funds of the people and companies that were deposited with the bank? In America, to a certain limit, the money deposited with the banks is insured. The limit is $250,000. But the clients and the customers of SVB were startups with a lot of money. It is reported that 89% of the deposit were uninsured. So, the receivership of the bank was handed over to the Federal Deposit Insurance Corporation. Customer deposits of $175 billion was used by FDIC to create a new bank, National Bank of Santa Clara. The assets of SVB were taken over and then began the search of a bank willing to merge with SVB. And there are some news about SVB merger with Boston Private Bank and Trust Company. Since this bank crash, the value of US banks in stock market has tanked. US banks have wiped out over 100 billion from the stock market, and the European banks have wiped out about 50 billion. It remains to be seen what the impact of the Silicon Valley Bank's collapse will be on the America and global economy. While some have drawn comparison to the 2008 financial crisis, there is a critical difference between the two situations. The 2008 crisis by the collapse of American housing market, whereas SVB's customers largely came from a specific sector. As a result, experts believe that the fallout from the SVB's collapse is unlikely to be served as the 2008 crisis, and a global financial crisis is unlikely. While there may be some impact on the startups that relied on SVB services, the broader economy is expected to remain stable. Ultimately, the full extent of the impact of SVB's collapse remains uncertain, and it will take time to assess the long-term implication for both the technology sector and the wider financial industry. And that's it for today's episode of Let Me Tell You. I hope you find our videos informative and interesting. Let us know about your thoughts in the comments below. We value your feedback and want to hear your thoughts on this topic. Make sure to hit that subscribe button and turn on notifications so you never miss an episode. Thanks for watching, and we'll see you next time on Let Me Tell You.